we have a couple of exercises to refresh our memory and to keep us alert with respect to balance sheet items, income statement items, posting to ledger, and so on. Articulation, it refers to the relationship among the financial statements. So we are talking balance sheet and income statement. What item in the income statement ties that statement to the balance sheet? So what do we have on the income statement that relates to the balance sheet? Revenue is an item on the income statement by itself. Expenses is an item on the income statement by itself. The difference between the revenue and the expenses, it is the net income. If you look at the balance sheet in our previous exercise, where do we have the net income? Where did we have the figure of the net income? Well, the net income is in the retained earning, and the retained earning is an item on the balance sheet. So here again, the answer should be the net income, which is the resulting figure from the income statement that shows in the retained earning of the balance sheet. The income statement. What's the income statement? It's a summary of revenue and expenses. It is used to report the results of operations over a specific period of time. It explains in part how the company's financial position changed over a specific time period. So, is it all of the above? Or is it the first one? The income statement is a summary of revenue and expenses. It is all of the above. The income statement is all of these functions. Office equipment was purchased for cash. What effect did this transaction have in the financial position of the company? They bought office equipment, they paid for it in cash. So office equipment, it's part of the assets. So they have bought office equipment, increase in assets. They have paid for it in cash. So they have reduced another asset. So asset decrease, liability not change, owner's equity decrease. So does asset decrease? Asset decrease, liability increase. Asset no change. It is C. It is no change because the office equipment is an increase in asset and the cash is a decrease in asset. So again, asset will have no change. And since asset did not witness any change, liability will not change and owner's equity will not change. Office equipment was purchased by issuing a check for $10,000 and a note payable for the balance of $60,000. So the total office equipment is 60 plus 10 is 70,000. They have issued a check for 10,000 and a note payable for 60,000. So a check for 10,000, it is as good as cash. So they have paid cash of 10,000 and a note payable of 60,000. What effect does this transaction have in the financial position of the company? Again, office equipment was purchased, so we have the assets increasing by the amount of the office equipment, by the value of the office equipment. So it is 60,000 plus 10, so increase in assets of 70,000. We have a decrease in cash assets by 10,000, and we have a note payable, which is a liability of 60,000. So which one is it? Asset not change, liability not change, equity not change. Asset decrease, liability increase, owner's equity not change. Asset decrease, liability not change, owner's equity decrease. Or we have both office equipment for 70,000, so an asset increase. We have paid cash of 10, so asset will decrease by only 10, so we have a decrease of assets of 60,000, and we have a liability, which is the notes payable of 60,000, which will increase. And since the asset increase, it should be equal, debit, equal to the credit. So Khalid, again, if the answer is C, owner's equity will not change, it's only asset increase and a liability increase with the value of the notes payable of 60,000.